The Federal Reserve has once again become the central focus of global markets. Recently, Fed officials signaled the possibility of an upcoming interest rate cut, a move that would mark a significant shift from their aggressive tightening cycle over the past 2 years. The markets responded instantly, with equities rallying, bond yields retreating, and risk appetite returning across multiple asset classes. But beneath the headlines, the implications of such a move are both complex and far-reaching. In this analysis, we'll break down what the Fed is signaling, why the market reaction has been so sharp, and what this could mean for investors in the months ahead. Fed signal: what changed? For much of the past year, the Federal Reserve has maintained a hawkish stance, keeping interest rates elevated to combat persistent inflation. However, the latest remarks from Chair Jerome Powell and several FOMC members suggest the Fed is more open to easing policy, potentially sooner than markets had anticipated. The change in tone comes as inflation data continues to cool, with core CPI and PCE inflation trending lower, while the labor market shows early signs of softening. In other words, the Fed may be seeing enough progress to consider shifting its priority from inflation fighting to supporting growth. Market reaction: why the rally? The reaction across financial markets was immediate and powerful. Equities surged, led by growth and technology stocks that benefit most from lower borrowing costs. Treasury yields fell, especially on the short end of the curve, as traders repriced expectations for monetary easing. The US dollar weakened, boosting commodities and emerging market assets. Even crypto assets saw a bid, reflecting renewed risk appetite. This reaction underscores how sensitive markets are to Fed communication. When the cost of money is expected to fall, risk assets typically rally, not only because valuations improve, but also because liquidity expectations rise. The data driving the Fed. It's critical to understand that the Fed isn't cutting rates simply to boost markets. Its dual mandate requires balancing price stability with maximum employment. Recent economic indicators provide a mixed picture. Inflation has been trending downward, but remains above the Fed's 2% target. Job creation is slowing, and wage growth is moderating. Manufacturing surveys and consumer confidence suggest weakening momentum. The Fed's signal likely reflects its attempt to engineer a soft landing, cooling inflation without tipping the economy into a deep recession. If growth data weakens further, the case for a rate cut becomes stronger. Global context. This potential pivot by the Fed doesn't occur in isolation. Global central banks are also recalibrating. The European Central Bank has hinted at cuts amid sluggish growth in the Eurozone, while the Bank of England faces its own inflation growth trade-off. In Asia, the People's Bank of China is already easing to stimulate demand. If the Fed does move toward rate cuts, it could realign global capital flows. A weaker dollar may relieve pressure on emerging markets, encourage carry trades, and support commodity prices. However, divergence between central banks could also create volatility in currency markets. Risks and contradictions. While markets are celebrating the Fed's shift in tone, risks remain. Inflation, though moderating, has not been fully defeated. A premature rate cut could reignite price pressures, forcing the Fed to tighten again later, a policy mistake known as the stop-and-go cycle. Moreover, while lower rates support valuations, they don't guarantee earnings growth. If the economic slowdown deepens, corporate profits may suffer, limiting upside in equities. Investors must balance enthusiasm with caution. What this means for investors. For investors, the Fed's signal presents both opportunities and challenges. Equities. Growth and tech sectors stand to benefit most, but cyclical industries may still face headwinds if economic activity weakens. Fixed income. Bonds could see further gains if yields decline, particularly on the short end of the curve. Currencies and commodities. A weaker dollar may lift gold, oil, and emerging market assets. Alternative assets. Crypto and private markets may experience renewed inflows as liquidity expectations rise. Positioning should remain dynamic, with close attention to incoming data and Fed communication. Conclusion. The Fed's signal of a potential rate cut has injected fresh energy into global markets, but this is only the beginning of a new chapter in monetary policy. The path ahead will depend heavily on incoming data, inflation prints, labor market reports, and global growth dynamics. For investors, the key is not to simply react to market rallies, but to understand the underlying forces at play. Rate cuts, if they materialize, will reshape risk pricing across every asset class. And in this environment, agility and discipline may prove more valuable than ever.